I'm pretty sure some of you have asked this question along the way. Why hedges have not covered at this point? All right, I'm going to try to weigh in this, with my opinion and try to answer this to the best of my abilities. Well, first of all, guys, you have to know that hedges, especially Citadel, who is the biggest short in AMC play, is really using high technology. Not only they're using high technology, but also they're having a huge competitive advantage over the retailers and anybody else on the market for this matter, because our orders are being routed not to the exchange where the share price is being calculated in order to reflect the supply and demand, because the more people are buying, traditionally and logically the share price should go up, but it doesn't happen on AMC, because personally at this point I really think this should be around 500 to 1,000 dollars a share. Just personally I think so far. Well, because our orders are being rerouted to Citadel, especially through Robinhood, and those brokerage, especially Robinhood, is making money off of this model, is really giving hedges and Citadel especially that little bit of information hedge. Like they know exactly how much volume is coming, and because they are receiving those as a package and paying whoever is sending those, especially like Robinhood for example, they are using that, and they know exactly when to manipulate, when to let it grow, when to let it run, and when to push it really down. And they are also using quantitative strategies, especially using through high technology in order to play with our emotions. When they shoot it up, let it run a little bit, okay? We go and excited, and then we buy, especially swing traders, day traders, stuff like that. And when they really think it's time to push it down, well, they push it down again. You've seen how they really tried hard to keep this thing below $60 a share since last Monday. For an entire trading week, they have been keeping this under $60 a share, okay? And we all know why. Well, that is, according to me, one of the main reasons why they think we have this advantage, so we're not going to fall easily. And also, guys, mentally, they think they are the smart money. They think they are the professionals. They think they have big pockets. And because of that, they went overboard. Like they borrowed so much money in margins in order to short this thing, because they really thought, hey, like Toys R Us, this is a done deal. It's easy peasy, lemon squeezy. But guess what is gonna get lemon squeezy now? The hedges, okay? Because things are gonna change. First of all, the New York Stock Exchange is trying to shift brokers working with these companies like Citadel to shift from that actual model to a model where they'll make even more money from working with companies like Citadel by sending our orders directly through the exchanges. And second, we have the SEC really making its mission to change this whole market structure, because not only it's affecting stocks like AMC and GameStop, but also, guys, it is really affecting more 401ks, IRAs, 529s, pension funds, which are also managed by other companies that are trading share prices and stocks like we, the retailers, and losing money on the table because of these practices between brokerages and hedge funds. And the SEC is really, really hard. So as a matter of fact, tomorrow, a new change in the rule, the NSEC 002, is gonna probably take effect. It's not officialized yet, but fingers crossed. If it does, it will really mean closely to the end of overextended short positions, which ultimately will force hedges to cover. And when they do, that's when it pops and we get to Tandy land. All right. So guys, I really hope I try to answer this question so you can see, even though they still have an advantage now, they're getting corner in corner. The corner is getting narrower and narrower, and it's not a matter of when. It's not a matter of when. It's really a matter of when, because it's inevitable, right?